Okay, so what we're going to do is go to a technical analysis using Yahoo Finance. And let's take a look a little bit more here. I put together some names for you like Amazon and Tesla and Apple, all the way down to Compass Diversified, Annaly Capital, Alibaba. These are the ticker symbols here. We're going to start with one share, and I just put some prices down here to show you. Basically, you could buy one share at 3,000. Right now, it's at $3,092. So, woohoo! You made a whole $92 for every one share you bought if you bought it at 3,000. But what we're going to do now is we're going to look way over here at a bunch of ideas and acronyms and names of things that we're going to look at. How do you do a technical analysis? Okay, so what we're going to do is let's start with looking at the idea of EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Okay, wow. So what the heck does that mean? Well, it's the earnings that earnings that a company has is very technical. And if you go through and look at the cash flow and the income statement, and you look at the balance sheets, you'll see all these figures and numbers. And basically, when a company makes things, they have to pay for all the cost of goods, and they have to pay all the staff and the salaries. Basically, that's your basic earnings that you make. That's like what we call pure earnings. So you buy a cup for 50 cents and you sell it for $1, you made 50 cents per cup, right? But there's also interest that you might have on loans, okay? Because bigger companies have these things. You're going to have taxes that you have to pay. So you didn't really make 50 cents because you have to pay a tax on it, okay? There's depreciation. And when you buy something in your store, quality goes down and the cost goes down, or the price or the worth depreciates. So when you buy a car, every year it gets worth less and less. So you would add all these depreciation numbers. Amortization just means if you bought something really big, you could break it down over, say, 10 years. You could pay for it over 10 years. You could pay for it in only 5 years. What they call amortization, which is a fancy term of saying we're deferring payments out. And so your earnings before interest, taxes, and these amortization ideas, basically, that would be the very bottom of the income, right? It would be very end, what's left over is the money they made. But these are numbers that we really want to look at because it's the pure earnings. And you see there that Amazon made $48.15 billion in 1 year. Now, Tesla's only at 4. Look at Apple, $85 billion. That's a lot of money. Now, obviously, if they did their taxes right and they did other things right, they might be able to keep more of that. So you might want to look at that. It just shows how much money they're basically making and how big they are. AMD's at 1.68, so quite a bit smaller than Apple, right? But Coca-Cola is quite a bit bigger. Now, so these are just, if you want to see what they're basically making, what kind of potential they have, you can look at that. Now, next one is called the PE, the price of the share on how much earnings they have. Now, PE, so if it's a real high PE, everybody says, woo, it's a high PE, it's very expensive. If it's a low PE, it's kind of cheap. But they say that, but it doesn't really mean that. So a PE, basically, Amazon, you're paying $73.94 for every $1 that they can earn. So you're like, wow, I'm paying $73 for just $1 in earning. Why would I pay that much money? Look at Tesla, $1,000 for every share you buy, and they're only making a measly $1, right? So why would you do that? Now, some of them are pretty low, like 21, 27. And the reason that people would pay money for not a lot of earnings, remember, we're hoping they grow in the future. If the stock is only $1 or 50 cents, then obviously the PE, it's like, well, it's only $1, so what does it matter? I mean, even if we had a really high PE. So it's a real mental game. So you can't really think of these in terms of what's cheap and what's expensive, because we have a thing called growth. Now, Amazon and Tesla are what we call growth stocks, Apple, because we think that they're going to keep growing and getting bigger and bigger. And bigger is better because bigger means more money, right? So PE, now the historical PE, you can look through there. A lot of times when I first started investing, your S&P was like at an average of like 15 or 18. Right now it's like 30 something. So it's pretty high PE. So these really high PEs, people aren't phased at 1,000 PE because they're thinking, hey, we know that Tesla is going to grow. Now, the growth rate, the real growth rate, the only way to find out is you're going to have to do research of the company because it's future earnings. So you want to go to their website, take a look at, let's say, AMD, find out what do they have in the hopper, what's going on, what kind of new technology do they have, are they going to be selling more? We can look at these things. That's why we have forward PE. So right now it's at 73 for Amazon, but they're saying, hey, maybe next year it's going to be $46. It's cheaper. Why? They're going to make more money. Amazon, they're saying it's 122. Wow. That's like a 90% drop, right there. But pretty crazy here, but these are PE. So take PE with a grain of salt. What I tell people is, what are you willing to pay for every earnings potential? Not for the share price, because the share price could be $3,000, but they make a lot of money at Amazon. So their PE in the forward's only $46 for every dollar they make. The PEG ratio is something people look at. Lower is better. Now, the lowest one here is General Electric. Now, they're expecting in 5 years that General Electric will get itself back on track and start making a lot of money. So anything under 1, a PEG ratio looks really good, but this is a 5-year expected. So I tell people, if we're going to do a growth, look in the future growth. How much can they grow their income really in the future? How much more money can they make? And then look at their PE, right? So if it's a low PE and they're also making a lot of money, you think they're going to do well, buy their stock. If it's like 1,055 and you're like, well, I think Tesla, I think there's going to be lots of competition and they're not going to be able to sell their electrical vehicles. But then again, Tesla has other technology they're working on, like batteries. So you have to do your research. Now, PEG ratios, again, are just your area of growing. So very low, like 1 or 2 PE would be very good, like Apple's at 2 and Compass Diversified is 1.7. Alibaba's at 47. Now, here's another interesting stock because it's a Chinese company. We're not really sure about the growth rate, but their PE is pretty low. And we know that Alibaba has been growing like crazy. So you have to do your research if it's a foreign stock that trades on the stock market here in America. So you can look at your PE and your growth. Earnings per share basically is pretty simple. Every share, how much earnings do they have? Earnings per share, not how much expensive. So it doesn't matter if it's a $600 stock or a $95 stock. This doesn't matter. This is just talking about the earnings per share. Now, Amazon makes $41 for every share. Their earnings for 1 share is $41. Pretty good. Look at Tesla again. It's only 64 cents. Wow. Now, we have $3.69. That's a pretty good earnings per share for Apple. Apple's making a lot of money. Advanced Micro's doing really pretty good. It's making $2. Coca-Cola is making $1.79. That's earnings per share. Now, we want them to make more money for every share out there. That's next year. So sometimes it goes up higher, which is good here because that means you're making $66, Amazon, for every share. In the past trailing 12 months, it was only 41. Now, if you go way down here to, say, General Electric, they're saying the earnings per share is 58 cents. Next year, it's only 50 cents. That is not a good thing. But then again, remember, these are estimates. So Earnings per share can just basically say how much money they're making. Negative is not good. Now, this is Annaly Capital we'll talk about later, but negative means they're not earning per share. But this company, minus doesn't mean anything because they have to give away all their profits that they make. So it depends on the company. But for most company, you want to see them making some money. Now, price per sales is a little peculiar because it's basically to get the price of the stock, they take the total amount that the money's worth, and that's like the capitalization of the stock. How much is it worth total with all their share prices, okay? And then they times it by the number of shares, and then they divide it by the sales. Not the earnings, but what they're selling. So remember, we can sell $1 billion or $5 billion, but we may only earn, say, $1, right? We sell a lot, but we don't keep a lot of the money. So this is price per sales. Lower, obviously, would be kind of preferable because you're paying a lower price for their sales that you have, but that's just the way it works. Now, let's look at book value. Now, book value is kind of where it's a little more complicated than this, but book value is you take all their assets, that's all the money they have and all their stuff they have, their goodwill and all their equipment. And then you take all their liabilities, all their debts and all their obligations and all that, and you divide them out. And whatever basically is left over is what you have left per share, the book value. That is like if we liquidated everything, we'd have how much money left. So if Amazon went bankrupt and they sold off everything and they said, okay, but they would still have $185. Now, the problem is the share price is $3,000. So obviously, if they went bankrupt, these share prices would drop down. But the book value just says, hey, they got some value. Now, sometimes they don't have a book value because Apple, for example, doesn't have a lot of stuff that can sell off. It doesn't have equipment and big old giant generators. It doesn't have these big fabrication machines. It basically does a lot of sales. It actually does all the technology. And they also do a lot in the area of services. So you might not be able to sell a lot of assets off, right? So the book value really is important for, say, a financial stock. For example, let's look at book value here. Now, Annaly Capital. Annaly Capital pays a big dividend. That's why it's an $8.31 stock, right? So this is what it's worth, $8.31. Now, you notice it doesn't have an EBITDA. It doesn't have a trailing PE. The PEG ratio shows minus. It doesn't show any earnings per share. That's because Annaly basically buys and sells, well, it doesn't really sell a lot of them, but it buys a bunch of mortgages. And then it gets a loan. So it gets a loan for, say, 1%, and it pays for the mortgage, a whole bunch of mortgages, your house and my house, and they only maybe have a 0.5%. They make a difference. They basically buy and sell mortgages, and then they take U.S. government debt and bonds and things, and they basically play with the interest rate. It's a very confusing company, but they do make enough money to pay off a dividend. Their dividend is like 10 or 12%. Now, they would have a book value, and you would want to look at the book value. If they sold off everything they had, how much money would they have left over? Now, notice this. It's an $8.31 stock. The book value is $8.92. 8.31 divided by 8.92 for your percentage would be 0.93. Now, if it was 1, that would mean that'd be like perfect. So they sell off everything. I have my share price at $8.31, and they go, hey, we got $8.31 left over. We're going to give it to you because we went bankrupt, but we want to help you out because you bought our shares, right? So the book value just means if they liquidated everything off, what would be left over? And then you have to divide that out by basically what kind of price the share is. That's why you see this one under 1. So lower would be better. And book value. And it's only used for certain kinds of stocks. You would not use book value for an Apple or a Tesla or an AMD or a tech stock, right? You wouldn't do that. Now, dividend per shares, if you want income, Apple's paying you 81 cents for every share. Coca-Cola pays $1.63. That's pretty high considering it's only a $48 stock, right? So then we have Ford annual dividend rate. In the future, they hope to go up. Finally, is price target. Now, right now, Amazon is at $3,092. Now, the estimate is 4,000. All the experts are like, in 1 year, Amazon's going to be a $4,000 stock. Well, these are just estimates, remember. Maybe it is, maybe it won't. So now if Amazon was only $100 and they're saying, hey, it's going to be worth 4,000, you might want to buy it, right? Because all the experts are saying it's going to be really, really high. So if it's really, really low, you would buy it. But if the estimate's only $57 and now Coca-Cola's $49, yeah, maybe it will go up $8 more, maybe not, right? Look at GE. They're saying, hey, in 1 year, it's going to be $12.31. So all the experts, they average them out, right? One says it's $15, one says it's $8. They divide it out and they're saying, hey, it's going to be $12.31. Well, GE is above that right now. So is it going to keep going up? Is it going to keep going down? Right now, the experts are like, it's fair value. That's about where it should be. So I don't always do the target estimates. Sometimes I look at them and see, what's the difference? And why is there a difference? Now, remember, all of these things we talked about. The PE is pretty solid. It's the price of the share by the earnings. Now, they change every year. That's pretty solid. The PEG ratio is more of a guesstimation. Now, the earnings per share is pretty solid because we know how much money they're earning. We know how much the share price is. Price per sales. Now, sales over there, sales are a little tricky because it depends on what they call a sale, right? Because some of these service people, they haven't actually sold anything yet, but people are paying them for future things in the future. So you got to watch out for the price per sale. Book value, again, just shares what's it worth if everything gets liquidated. And then your dividend yield's good if you want to make money. So you kind of want to balance all of these things out and do your research. The most important thing would be go to their website, look at what Apple's doing, go and listen to the analysis of it, and really listen to when they come out every quarter and they do their earnings statement. Please listen to those transcripts or read over them for every company you own and see if AMD might have some future things in the future. Maybe they're struggling and you hear these things, you might want to sell it if you think in the future they're going to go down. Remember one more time, the forward PE and the next year estimates, that's what you're really hoping for, is the growth of the stock. Most of these numbers, the current PE just tells you where it's at now, doesn't always tell you the future. You always want to look to the future.